let's start by looking at the CMC and Al-Futtaim deal. What does this mean generally for the automobile sector here?
I think, in essence, we are looking at a new player coming on board. CMC had a very good portfolio of products. We're not sure of the exact strategy that Al-Futtaim is going to bring in, but certainly you're going to see a lot more competition in the sector. Obviously, CMC has lost quite a number of franchises in the interim period where you had the squabbling in management and the regulator investigating them. But I think, in essence, it was a deal that at least helped the shareholders recoup something from that transaction.
Let's talk about the shareholders. How much are they making from that deal, and would you describe it as a good deal?
I think it's as best a deal as they would have hoped for under the circumstances. If you look at the circumstances surrounding this transaction, there was the corporate governance concerns that came up, the CMA starting to investigate, and the company was actually starting to lose the key franchises, and they were actually now really teetering towards loss-making territory. And I think continuing in the manner they were going, it would have been an even worse deal. So before their shares were lifted from suspension, then that's when this deal came after the main shareholders.
So it was basically a stitch in time.
Yeah.
Now, of course, CMC has quite some valuable land, which is averaged about 2.5 billion shillings. We are hearing reports that Al-Futtaim has announced it is interested in getting into retail as well as property development. What do you read into that?
Yes, certainly. I mean, given no other person made an offer for CMC, I think Al-Futtaim just looked at maybe the portfolio of assets, looked at the car franchises, and figured out that they would be able to generate value out of it. So it's just a matter of time to see how they're going to perform. I think, in essence, they'll probably need to invest a lot more into the business in order to gain value.
And of course, they are exiting the stock exchange after this
sale.
Yes,
certainly. With now they've attained the 90% threshold. So any other shareholder who didn't accept the 13 shillings offer will actually be bought out compulsorily. That's
the 8.4%, so to speak, that did not sell did not agree to it in the beginning. Let's look at TransCentury, which has surprisingly announced its exit from Rift Valley Railways after 7 years. We're seeing mixed reactions on that move. What do you think informed that particular move? Well, they had a put option, so essentially they had the right to sell their stake to Citadel. They don't control the rail business, so Citadel are really the main shareholders in RVR. So the entity which actually controls the 25-year concession of the Nairobi Uganda rail. I think they must have got a good price. They didn't disclose what price they actually got, so we've just made an estimate, and we think the transaction is anywhere between 4 and 6 billion. So it could come in less, could come in more, but we think that's probably the range. It's a good deal. It definitely meets the threshold. If it comes within that range, it will at least meet the threshold in terms of IRR for investors. So it will be a good deal, and we provide cash for them to invest in other parts of the business. We're also hearing that TransCentury is now stretching into minerals, oil and gas. How do you see that impacting the stock on the stock exchange? So TransCentury is primarily the only listed entity which is really very well in the center of oil and gas, but it's really more supporting the explorers. So it does that through Civicon, so that's the engineering division, and it supports Talo. Talo is its client both in Kenya and Uganda, and Civicon also has operations in the DRC, so in terms of mining. So that's a very key area, and for a listed company, I think it's something that is very positive. Obviously, these funds, when they raise them, they can't really just put it into Civicon unless they have an agreement maybe to raise their shareholding. Last year they were looking into power as well, but they didn't manage to get into, I think they wanted to produce power in Menengai, but they didn't win the contract when it was floated by the government. So I think it will probably be between power
and oil and gas, but they are very keen on oil and gas.
Okay, very quickly and finally, Safaricom and the Essar deal. Safaricom has been quite a good performing stock, at least for the beginning of this year. How do you see this deal impacting that stock?
Well, at the moment they haven't disclosed the price that they're buying the assets. And from what we understand is that the CCK also offered very tough conditions for Safaricom to buy the assets of Essar. Primarily, Safaricom is looking for frequency. So if you look at the way frequencies are distributed in Kenya, it's not based on market share. So Safaricom gets the same number of frequencies as the other smaller players. So that's why they wanted to buy Essar in order to get those frequencies. So that would have been good. But now they're being told to open up their network to other players, so MVNOs, as well as their M-Pesa agents. So from a competitive perspective, that's negative. But we are yet to see their final decisions on that.
All right. Thank you so much for your insights. Eric Musau, a research analyst with Standard Investment Bank, giving us his look at some of the mega deals that have been taking place in the marketplace.